what I like to do is I want to cover just a couple items that we went over during the last session with Professor, and he did go through quite a bit of material. We had certain modules of information we wanted to go through: analyzing currency pairs, understanding currency correlations, your different types. He called it his game plan, but the different types of trading styles like intraday or day trading or swing or position trading. So we'll cover that as well. So let's just go ahead into it. Let's start first with the different lot sizes and the different value for those lot sizes. So for example, who can tell me what is a standard lot size? You can also unmute your mic if you want. 100,000, bam, good stuff. So 100,000, okay, would be one standard lot, okay? And so forth and so on. If you guys had a mini lot, what would that be?
10,000.
How many units would it be for a mini lot?
10,000.
10,000, perfectly. Okay. And for a micro, what would that be? How many units?
1,000.
1,000, perfect. Yeah. Now, why is this important? You guys know when you're trading these different currency pairs, one thing that you always need to understand is that they all have a different unit pip value, okay? And each currency pair's value is going to be different. So for example, I think the one that's closest to, let's say, the actual standard value, the micro and mini value would be the Euro USD, okay? So other currencies have a different pip value. Some of the currencies may be, instead of it being 10 cents per micro, it may, as the value, pip value goes up, it may be maybe, let's say, it could be 9 cents, okay? So that's why this is important to go over the actual pip value. And when you guys start plugging in your trades, you'll see that pip value change, but the euro will be the closest to 10 cents, you know, a dollar movement or $10 per pip movement. And if you play with the different currency pairs, the brokers usually adjust them. I don't know how often they adjust them, but they do usually adjust them as time goes on. It could be year, it could be annually. So one of the things that we also need to talk about, okay, any questions on that before we move forward? Okay, so part of the recap, also what we need to discuss is the currency correlations. The reason the currency correlations is so important is that you don't go against the actual producing country's commodity. And not every currency has a commodity back, like you might trade like the Singapore dollar. Right now we're in the large trade, and it may be a cross pair. So just for kicks and giggles, just kind of go through it. Who is which country is a large producer of oil? Not hoarder, because the US would be a large hoarder. But as far as a large producer,
Canada.
Canada, perfectly. But we would be trading the CAD, right? Or they call it the loonie. So for the CAD, that's going to be oil because they are one of the largest producers. They go hand in hand, back and forth with, I think, Saudi Arabia or Middle East. Who is the large producer of gold?
Australia.
The largest.
Australia.
Australia and New Zealand.
Now, I want you guys to understand something. So the New Zealand dollar is the largest producer, okay? So of gold. Australia dollar is the largest producer of silver and gold, okay? And then we also have to understand that these are all positively correlated, right? When it comes to which inverse against a major world global currency that we use in the markets, which is the US dollar.
Dixie.
Yep, it has many names, right? The Dixie. They also call the dollar, you know, different names. They call it the Dixie, the USD, or whatever the case is, but it's the Dixie. So the Dixie would be a negative correlation to the other ones, right? So we have this recap. Also, what we covered during that time was pivot highs and pivot lows. Now, if you're trading in a trending direction of a market, okay, and let's do this. Let's go trend, okay, and let's make this a uptrend. How can we identify an uptrend is continually going up? Is it just because we have rallying candles, or maybe because we have confirmation it's creating something?
Higher highs, higher lows.
Higher high.
Okay, so that means we have, I wish I could draw this thing. So we have higher highs of what?
Pivots.
Bingo. And we have higher lows.
Lows.
Now, if we're going to a downtrend, right? What are we expecting?
Lower lows.
Lower lows. Low highs.
Bingo, right? And we're talking about the pivots. Now, that will leave us with the last one, which is, of course, sideways. Now, in a sideways market, I want to talk to you guys about two things. One, a sideways market doesn't have to be perfect. What you're looking for is relative equal highs and relative equal lows. And the reason for that is because people feel that it has to be a perfect pivot that touches across when you draw a horizontal line. It does not have to be, okay? I have yet to see a perfect chart, and even looking at a perfect trade, or what we call textbook in our trading world, it does not always look perfect. So it doesn't mean that it's going sideways necessarily, because guess what? In a sideways trending market, it can have a wide range. It can also have a narrow range. What else can a sideways market be doing? Can it get tighter, like in a triangular pattern?
Yep.
Okay, so we can have a tight range bound. I'm just going to abbreviate. So if we can have a tight range bound and price of the market started going in, let's look for that really quick. Let's go back to the market. Okay.
Would that be considered a wedge, Lamar?
Absolutely. So we have one right here. I'm gonna map this off. So this right here, what they call a triangle or a wedge pattern, this is still sideways, except you have this movement where the highs are getting, the lower highs and are getting here, and then the higher lows are moving up slightly. So it does not have to be perfect going across to say that the market is sideways. It doesn't have to be tight range bound. So if this can also set up for what we call a breakout trade, this is where we have a market that said, okay, we're going to start getting tighter and tighter. That's giving you a direction. There's always a saying for this: the trend is your friend until the
And up the bend of the end.
the bend at the end. And the reason why it's a bend at the end is because we're talking about it's getting ready to break out. It's a battle going on between the bulls and the bears. They actually did it twice. They actually did it down here as well. So there was another breakout. Now, we don't just trade the retail traders breakouts. What we do is, and we'll get into this when we get to candles, is we're looking for what we call supply and demand around the breakout, because it is a trap for the retail traders trading the breakout itself. Okay. So one thing that we need to look for also is, the market can also go a range bound where they call these descending triangles, but it also can be ascending where the market starts going this way. So let's look for that really quick before we move forward. See if I can find something here. Let's change the time frame. Let's go to the 20-week, 4-week. And where you'll find one primarily in the market that is, you guys know that the pound and the euro is kind of like almost hand in hand. Same thing with the Japanese yen and the Chinese yuan. So it's kind of like, why would you trade those two? They're almost working hand in hand. So there's a lot of sideways movement in this. Forex is known for a lot of trends, but this thing is really sideways very often, and then it spikes. Then it spikes, but it goes sideways. Look at this sideways movement. So maybe
Ugly.
we'll find one. Go ahead.
Ugly, I said.
Yeah. It's definitely very choppy, especially when you start getting really, really small in time frame. These things start looking really crazy and chaotic. But anyways, I just want to point that out, that triangles can be ascending, okay, and they can also be, descending, where they start to go up like this, and that still can be considered a sideways ranging market. Let's go back and share the other post. So just some tidbits. Now we can say tight, we can say narrowing. Let's see, what else do we have? Let me look at our sheet from last week. We also cover supply and demand. This is a very big one, actually. Let's start with the pivot highs and pivot lows. When I started to learn how to trade, I
So
had
Lamar, can I ask you something before you move on to the next
sure,
topic? I don't know if you're done with this one. So when we have both, right? Pretty much in like when it's to the the other one, how do you call it, the ascending one?
Mm-hmm.
It's pretty much, is that what it's saying, is that the pretty much the range is exhausting and it's ready to break out, right?
Yes.
And then
you're talking about this thing right here.
yes.
Yeah.
Yeah. So
and the rule of thumb for this is typically in the direction that it's been going in, they're expecting a continuation. This is retail trading information. We don't trade that exactly, because guess what? They don't always work, and they can go against you and go down, right? And so they can look for a lower zone before it goes up. It may go like this, and then it can go up, or it can go sideways. So we don't trade that specifically itself, but the rule of thumb is in the direction that it's going, so it should continue. So let's say that this is here and it started to come down and it made this type of pattern. What we're expecting is for this thing to go this way. Okay.
so what about on the other one, on the open one, when it's it's reversed?
When it's ascending like this.
Yes, ascending. What does that mean? That it's also a breakout, or?
Well, you're talking about when the market starts to do this, and it gets wide ranging, right?
Yes.
Yeah. What's happening is it's consolidation. Okay. And can it still break out? Absolutely. What I see very often, and it's a little bit often, we got to get back on topic, is the market will create another range within this range. And it's a little bit beyond the scope of this workshop, but what will happen is it will create a new range that didn't break out. The retail information that people trade, a lot of this stuff is for consolidation. Range-bound markets are for consolidation, trending, triangles that are descending or they're ascending into a point before they break out. It's really consolidation, and it's flat. It's also called a flat market as well. Okay.
Thank you.
Does that help you out? Does that answer your question?
Yep. Thank you.
You're most welcome. Let's go back to our notes here. Now, so what we've covered so far, recap on some of the correlations, some trending markets. Let's see, what else did we cover last week before we move forward? Supply and demand. Oh, pivot highs, pivot lows. Here's something that's very important that I want to cover with you guys. When I started trading in the market, there was some information that I accrued from. Let's go to a normal looking pair or something. Let's look at this. Okay, let's just take this like this. When I started, I actually I had a hard time reading trend. Just looking at this, can someone please let me know what direction is the trend?
Down.
Right, it's down. What about now?
Sideways.
Okay. Now, one thing that I want you guys to understand is the price of the market on this picture, just from what I have right now, is right here, right? And current price, is current price lower or is it higher than where the price of the market came from?
Higher.
No. It's lower. It's lower.
Oh.
Current price. If this was current price right here.
Okay.
Is it lower or is it higher than this?
Oh, yeah. Lower,
right?
lower.
Right. It's lower. So the trepidation, the reason why I bring that up is sometimes when we're trading and investing, we will look at something that is going up, but you also have to go with the highest time frame trending direction, okay? Because that will give you the big picture, and you got to be careful about counter trend trading. We're going to get into that. That's one of my topics today. We get enough time on the bonus round, but just looking at this overall. Now, the reason I did this because these markets make pivots. You have a pivot high here, right? And let's fill this triangle and drag it over. And you have a pivot low here. If you were to take this entire picture and map this off, this is your pivot high and this is your pivot low. Why didn't we use this one here? It's too close to current price, right? And quite often it's in the middle of everything. And we don't do what, guys?
We don't swiggle in the middle.
So who can tell me why we don't do that, though? What's the number one reason why?
Price action is too volatile. Don't know which way it's going to go.
It go either way.
Right. And here's what happens right here. Everything in here in this bell curve is very choppy. Imagine trying to go long in this trade. And you're going through this right here, right? I mean, this thing based for literally, geez, October all the way to March 2019, several months in there. That's brutal. And this is only a 3-day. If your target's way down here, and that's why we want to buy at the lowest case possible and sell at the highest case possible. And that's what we went over last week with Professor. You want to stay out of the middle because it's choppy. Some people can catch the range. If you catch it, you know, a little bit lower within it, but we really want to stay out of the middle. It's really for more advanced trading and analysis. But for the rule of thumb, just stay out of the middle and it will keep your account safe. Hopefully you don't get through all this choppiness. That's in our books, that's a no-no, right? So the last thing I need to cover with you guys before we move forward is the supply and demand and support resistance. And we're going to start with support and resistance. Supply and demand. Let's go ahead and just clean this chart off. Here's what I want you guys to understand. The formations. Who can tell me the formations in the chat? And we're going to write this on our handy dandy notepad as well. But in the chat, please tell me, what are the formations that we've used for going long in a buying trending up market? What do we need to look for?
Rally base rally.
And
Drop base rally.
Drop base rally.
drop base rally. Absolutely. So let's look at let's cover supply and demand really quick, okay? So if we're trading for demand, we need to be looking at rally-based rallies, and we need to be looking at drop-based rallies, okay?
Correct.
Let's go to the market really quick. Let's identify this. Okay, let's go to share screen. Okay. Let's see. We got one right here. Okay. So we have this rally leg in, we have this basing candle, and we have this rally, this leg out, right? So the retracement from that, we expected this to come into the level and bounce out. Is this a continuation pattern or a reversal pattern?
Continuation.
Continuation. Okay. Why?
Because it continues the upward movement.
Yes. And you find a lot of those in a trending market. So in demand, when you're looking for a rally-based rally, okay, rally-based rally is called a continuation pattern, okay? The other one would be what? Drop-based rally. So that makes that a reversal, right?
Reversal.
Right. Now, reversal patterns, the most reversal patterns are found where?
Higher time frames.
No, not necessarily, right? A reversal pattern or drop-based rally is typically found at the bottom of a trending market.
Off the pivot.
Right? I mean, there's different names for them all, so they like to call them, you know, they like to call them like shooting hammers or something like that, like this guy right here.
Shooting stars
Shooting stars at the very top, Haramni patterns. I don't want to really get into
and
that.
golfing.
Well, the engulfing pattern would engulf two candles. So like this one right here is an engulfing bearish candle that engulfs these right here. I'm not going to get into that. That's retail trading information, but you know, it's just they wanted to be cool, so they created some names for it. But this pattern right here is a drop base rally, right? And this is typically found at the very bottom of a trending market. Now, this one right here retested into it and shot out. That worked, right? But when we find these patterns, it's just a reversal. It just gives us a sign that, hey, you know what? The market came all the way from this point right here. And as the market dropped, came all the way from this point, it got down here and it reversed, okay? And it started to go up. So this is just a direction. Now, it really got sideways, but guess what? The market still changed its direction. Although it went sideways, slowly going up, the market still changed its direction. So these are also found at the very top of the market. Now, if we're going to go about the buying opportunity, we also need to go for the selling opportunity. So in a selling opportunity market, oh, sorry guys, wrong one. Let's go to my.
So Lamar, can you say that drop-based rallies are reversals, right? So then
correct.
we will not see them for pullbacks.
Oh no, you'll find them for pullbacks. So if you were looking at a pullback in a drop-based rally and it's in a continuation of a rally going up, let me give you some rules of thumbs really quick, okay? Let's go back to our chart here.
Yeah, because I get a little confused onto like, you know, that's something that I'm practicing right now. The difference between pullbacks and reversals.
No problem, no problem. Okay, so let's see here. You have one right here. Okay, let's see. Let's actually go up in time. Let's go to a 1 week. Okay, it looks a little bit cleaner here. Now, it's not the best looking one, but it is one right here, and it's in the continuation pattern, right? First of all, we shouldn't be buying where?
High in the curve and low in the curve.
Right. So if you do find one.
I mean, buying low in the curve.
Buying at the bottom. Yeah.
Correct. That's, who was that? Is that Benji?
Yes.
Okay, perfect. So let's put some rules in here. Okay, while we're here, this is just extra bonus. If you're going to be trading a drop-based rally, not at the bottom, okay, of the market, and it's high, or let's just say above 25%, which is low in the curve, okay, to let's say 50%. Okay, I'm going to even throw you that because you may be an advanced trader. If you're not buying lower and you're typically seeing these higher, you better make sure that this is an authentic level now. Meaning we have a wall that separates it and creates an authentic level. Okay. So let's see. Let's go to our chart here. This is not a good wall here, okay? That's why it didn't work. But this one right here is still above the, oh, I'm sorry, guys. Am I sharing this? Yeah. Can you guys see this, Euro USD?
Yes.
Yep.
Okay, perfect. All right. So if anything, if you're buying these, you want to make sure there's a wall, okay? And what I mean by that is, this kind of takes some blank graph here, and let's just kind of draw this out. Let's make this guy green, okay? Let's say that the price of the market went up. Now that the price of the market went up, it started to, in an uptrend, it started to create this, this formation where it started to go up right here. And now you have this drop base and a rally out. you need to have a good solid, oh, this thing gotta go away. You need to have a good solid wall here, because this wall means price of the market came up, right? It wasn't in a trending direction like this. The price of the market came up. That means anything beyond here makes this guy fresh and authentic. Fresh and authentic, the difference between them is that this is the very first time that the price of the market created a brand new level and has a higher probability that when the price of the market gets back down here, that it will retrace in a trending direction. Does that make sense, guys?
Yes, it does.
Because what happens is a lot of people will take these and the price of the market looks like that, and what happens is they'll break right through them. Okay, so we want to make sure that when we're trading these, it must be authentic. I think Jennifer, you asked that. Does that make sense to you, Jennifer?
Yes, yes. I'll spot it. If you spot something, just let me know in the charts whenever you're.
Absolutely, I will. So buying above 25 and 50%, make sure that it is it's an authentic level. Okay. And it's a little bit, we're going to get into these like authentic levels, level on levels a little bit as the course progresses. Remember, guys, this is basic fundamental right now. Okay. We're already about 30 minutes in. So now, if we're going to recap on supply and demand, also in supply, what kind of formation should I be looking at?
Drop base drop.
And rally base drop.
Rally base drop.
Okay. And which one is the continuation pattern?
Drop base drop.
Perfect.
Correct.
Okay. And which one is the reversal pattern? Of course.
Rally base drop.
Right. Now, there's two other patterns that I want to talk to you guys about. And these patterns are very unique. And we use them sort of as kind of like odds in our favor as an enhancer. So one of the patterns is called a level on level, where you have you got like a double demand zone, and a level on level where you have a double supply zone. Okay. There's rules for these. We're going to touch bases on these a little bit. I'll spot it out if I find one. But a level on level just means that the institutions created an additional level. Sometimes they look like an immediate retest. You've heard Professor, myself, Cynthia, we talk about these. Sometimes they don't touch, which is a higher probability, okay, that the levels will work. And we have rules for them, so we're going to cover that as we go in. But what you're looking at is essentially where you have two demand zones that are literally right after each other, two supply zones. And usually it's a rally-based rally, okay? Or it could be a drop-based drop. So let's go ahead and recycle this chart. Now, I'm pretty sure there's quite a bit in this one because of all this choppiness. But typically, we don't want to just trade any one of them, because this is nothing but level on levels on levels on levels. You want to catch these on the highest pivotal areas of supply, okay? And let's see if I can find one here for you guys. And they also do not have to be close to each other, okay? Professor, he enlightened me with that one before. He said, hey, man, that's a level. I said, where'd you see it? So, for example, you have this one here, this sort of rally-based drop, right? And then you also had something down here, which was a drop-based drop. But typically, they're literally staggered right by each other and sometimes a little bit higher. We're going to get into that as the class progresses, but just kind of give you guys a glimpse of what we're going into, because this is advanced trading as it will progress into it. But right now, let's keep it fundamental. Let's keep it basic. All right. Now, we're ready for the nitty-gritty, guys. Let's jump into it. I really love this topic about supply and demand because it's one of my favorite topics to talk about. And one thing that you guys know about me is I'm very big on finding the right formation in the right location. Okay, so I'll make sure that you guys get these notes in the group. But let's start a new page here. Can you guys see this?
Yes.
All right, perfect. One thing that we need to understand about supply and demand is that not only do we have rally-based rally and we have a rally-based drop, In supply, the formation is so important. The formation for supply is so important because let's just do something random. Someone just throw out a currency for me, something just random, whatever you guys want to look at. It could be a commodity as well. It could be something in the K. I don't care what it is. We'll look at it.
CAD yen.
Do you say again?
CAD yen.
CAD yen. Okay. We got the CAD yen right here. Let's go up to a 52 week. Hey, what happened here? All right. Let's go to a 52 week. So for the CAD yen, oh, that's too much. Let's go to my favorite. For the CAD yen, the pivot points on this, here's current price, right? The pivot points on this market, what I would utilize from this 4 week, right? In my opinion, this pivot is too close to current price. Although it bounced off of it, I would use this guy to this guy. Now, if we're looking at the pivot high and the pivot low of this market, one thing we need to understand is the right location, right formation. I find very often people trading in the middle of a intermediate time frame. If your pivot high and your pivot low is on a 4 week, an intermediate time frame would be like the 1 week. And so just because current price is here and you just want to find a zone and they'll say, okay, well, hey, look, I got a zone right here. Is this not a clean zone at the top of a pivot?
Yep.
Yeah.
Absolutely. But looking at what we call multiple time frame analysis, always go back up to the higher time frame to see where you're trading it at. So this one would be where, guys? Middle.
In
Yeah.
the middle.
Middle.
This would be in the middle. So you always have to check your work. Now, this also leads me to another point. Sometimes people like to trade multiple time frames, but they'll use a target 1, target 2, target 3, target 4, target 5, whatever, et cetera, et cetera. What they're really meaning to do, and I don't know if they all understand how this works, Wall Street and the way they work is they'll use multiple time frames and multiple targets, and this will be T1 here. This will be a pullback. They'll find another one. Maybe this is T2 here, okay? And they'll find another one. Maybe this is T3 here. What they mean to do is these guys who are trading multiple time frame targets, what you're supposed to do is not just look at it as a target, we've reached it, but understand that you need to lock in profits to pay you. So we'll say, we'll take, the way Wall Street uses this is we'll take half of our positions off and let the other 50% of our positions run to T2 and T3. So that way, this is at a no cost, risk-free trade to you. What we don't want to see is a lot of pairs will trade and they'll go like this, up, and then they start to come back down all the way to the area where the original zone is. Has anyone ever seen that before?
Oh,
Yep.
yeah.
Absolutely.
And then we end up giving our pairs back. But guess what? The people who were letting all of their targets go up and they didn't lock in profits at least. And I'm not talking about stop loss. That's completely different. I'm talking about shaving a position. Now, if you had a stop loss, you say, hey, look, I want to raise my stop loss up. There's nothing wrong with that, putting it under the next pivot. If it created a pivot here, there's nothing wrong with that, okay? But what we want to see happen is we start to get into a risk management where we get to the point where we say, look, we need to lock in lunch. Because if you've already made over 150, 300 pips, and you have about 1,000 pips because we're wealth trading most of the time or swing trading, guys, you got to lock in some profits because we're here to make money. We're here to make an income, not just give our gains back to the market and we leave frustrated with emotion. So we're supposed to lock in 50%. This is how Wall Street does it. The next one, they'll say, okay, we'll take 25% off. And then the next one, we'll just close out the trade. And that's how Wall Street actually does it. So we'll get into this on lesson number 9, where we go to trade management. But I just want to give you guys, always give you guys a glimpse before we actually do the action. Okay? Does this make sense to you guys?
Beautiful.
All right, perfect.
Yes, it does.
Perfect.
You were asking about Jennifer.
Yep.
You said you asked about this, Jennifer?
Yes, I did last week on trade management.
Okay, perfect. And we're actually going to go into trade management. That's lesson 9. So let me do something really quick here. Okay, I'm just going to share this. This is what we're supposed to be doing. And we've already we recapped some of the understanding the correlations. We went through, the pivot high. We went through supply and demand. We're still kind of cutting into that as we go into the next topic. Analyzing your currency pair. We're not going to redo the very, very first one that I think Professor, he hit that on the nail and beat a dead horse quite a bit. So let's go back to what we're going to cover in support and resistance, supply and demand. So with supply and demand, guys, it's important to find the right location. We want to be buying lower on the curve. We want to be selling higher. The level on level orders, I need to find one for you because this is so important to look at this. The level on level orders, this is a retest and not a level on level, okay? Let's see here. Let me try to, okay, I got one for you guys. A level on level does not have to be directly after, and I'm glad that we have this one here. So we have one here and we have one here, okay? And I'm going to find one more for you. Okay, let's see. Run out of real estate here. Okay, let's focus on these two first for supply. Let me get rid of this guy and get rid of my Fibonacci. Now for a level on level, there is rules to this. This level on level had a strong move out. Before we finish the zones, let's cover what the, let me delete this just for a second, guys. We need to cover what the actual odds enhancers are that give us an identification that this is a strong move out. This is a quality zone, so it's always quality over quantity, and you can be very picky at this. So the odds enhancers that we most commonly use, there's quite a bit of them out there to give us favor that this is a quality area that institutions are buying and selling. The first one is strength. Okay. This next one is time. We're picking up where Professor left off of supply and demand. The next one is going to be retracement. And we're going to cover fresh versus authentic. We used to call it authenticity. And level on level, as well as correlations. Okay. Let's start with strength. If you need to identify a quality zone, you have to think of it like a basketball. The highest bounce of any basketball, I'm going to attempt to do a little drawing here, guys. Okay. If this basketball starts to bounce, can you guys see my screen?
Yes.
Yes, yes, we can.
Okay. Yep. If this basketball starts to bounce from, let's say, 10 feet, and it came all the way down to here, we know that the initial bounce of this basketball should be what? The highest, right? Could this ball continue to bounce after that? The next time it bounces, maybe it's not so high, but you got a good bounce out of it. And then the next time, and then the next time. The reason I'm drawing this out is because the way the institutions work is they may come in here with a huge position. Let's call it $1 trillion of a position in Forex. Let's call it, maybe they're trading the S&P 500, and they're coming in with 800,000 shares. I didn't say dollars. Notice I said shares. That's quite a bit, right? Right. Especially if one share is 2,500 per share. That's quite a bit. So what we're doing is, what moves the market up is not the fact that you have orders here that are filled. It is the unfilled orders. So the first time that they get a bounce into this level, the institutions, when they're buying and when they're selling, these guys are taking a chunk out of whatever is here. The next time they come back, they're taking another chunk out of whatever's here. Okay. Oh, whoa, this thing is all trippy. And then they're going to get another one. So this means that they're eating these orders, and eventually the price of the market will start to go down, and it will break through this area. Okay, it will start to go a little bit down. The reason for this is, and it may not necessarily, just because you find a level doesn't mean that the institutions have orders here. The market makers like to create levels, but then if they have an order book where they can see levels a little bit below it, where there's more quality, they will drive the price to market, because they have the ability to do so, down to a lower level to hit the orders that they want. Some people get frustrated, although they're trading on the very low part of the actual curve where you should be buying low, selling high. They're buying low. They get frustrated because the price of market may go down to a lower level. It may come down to here. And people say, man, my zone didn't work. And that's why we always promote using a stop loss. We have to be rigid in our rules, but flexible in our understanding. A stop loss is going to keep you safe in case we are wrong. That is your risk management. You don't want to blow up your account. So trading without a stop loss would be a no-no. The price of market came down here, tested this level, but you have to understand the institutions, if there's not enough orders here, they will drive the price of the market down to a quality level. Okay. Does that make sense to you guys?
Yes.
Okay. So let me go back to this guy right here. Okay. So we're going to look for strength, time, and retracement. I'll explain what all four of these mean. Okay. When you look for a zone, the strength of the movement of these zones, I'm going to give you guys a little bit of information that has helped me tremendously in my trading, that I don't really share all of my secrets because it's stuff that I've worked on for so long, but I had to scale back sometimes because I can get very technical on my analytic. But one of the things that I want to share with you guys is, when you're looking for strength of a zone, let's just say that it's this zone right here. Okay. As the price of the market starts to come back to this zone, you have a rally base rally up, immediate retest of the level, and then it shot out. Okay. I'm not so much concerned. First of all, we're on a 1 week, right? So people will say, well, it didn't do all this, but look, if you measure this out, that was about 300 pip movement right there. Look at this zone right here. Look at the movement from this zone. This is literally almost 1750. That's a lot of pips out of this area. So what we're looking at essentially is, when you're trading in these zones, we want to make sure that it's a strong leg movement in. I don't want to see choppy candles. When we say strength of a move, we want to make sure that that movement is as vertical as possible. That's that basketball bouncing the first initial time. People think, and I know this is something that may be new, or you guys haven't heard of this before, but people feel that just because the price of the market bounced once and came out of it, that's the first move. That's actually not the first move, guys. Who can tell me what the first move is?
It's in the bottom.
No, the zone itself, right?
Oh, yeah.
Yeah. So the zone itself would be move number 1. Next to it, when it passes it out and it starts to bounce out of the zone, is move number 2. If it comes back and touches it again, that will be move or basketball number 3. The great thing about Forex is that these zones will come back and forth because there's so much money in there. They will retest more than any other commodity or any other stock. That's why when you look at different asset classes, you have stocks, you have futures, you have Forex, you have options, you have cryptocurrency, right? You have the world spot market, you have the diamond industry. I trade in various markets. When we look at this, this is the initial movement. Typically, we want to see a strong leg out, okay? We don't want to see it choppy. This is the strength of the move. People get strength and retracement mixed up. The retracement is saying this: how far did this thing come out before the trend starts to come back? That's retracement. So let's not get retracement mixed up with strength of a move, okay? This vertical movement, high probability. These are long candles. That was about 300 pips. This choppiness, I like it, but I don't like the fact that it became choppy. Look at this first leg out. When you look at, let me zoom in for you guys. Okay. When you look at this move out, this basing candle is not that much bigger. This leg candle is not that much bigger than this base in this rally base rally. I'm not a fan of this movement. The only thing I'm a fan of in this would be the retracement. How far did it go away? So when we go back to our actual notes here, the strength of the move, I'm going to say this. The very first candle needs to be at least 2 to 5 to 4 times larger than the entire expanded range of the base. So with this one, we don't have that, do we? You guys see that?
Yep.
Yeah.
136, 181. Let's look at another one. Right? So at least 2 times larger, okay? Now, they can be choppy and broken, but I like to see the strong moves out. That gives me high probability that, man, they're literally going to come back and drive the price of the market up. So when you look at this for the strength of the movement, what also is important is not just a leg out candle that's long and lengthy. One vertical, leg in candle. That gives me high probability. The arrival of how they came in, this is what I'm looking for. You see this long move right here on this drop base rally? That's a strong movement in. Okay, that's a very strong movement in. It's a solid candle. This rally base drop right here, this is a strong move in. I don't have this choppiness. I don't have this basing away. That's, if I had a scoring system on a 1 to 3, this would be a 1, right? I need something that's going to give me high probability that there's a lot of strength in there. And where there's a lot of strength, that means the institutions, they favor this area for a lot of unfilled orders, meaning the basketball that's there, when the price of the market is coming to this level and it gets back up there, it's going to be the highest probability it will strongly move down. Now, the next one is going to be not just the time, but let's cover retracement because strength and retracement almost work hand in hand. So the retracement of a candle simply states that when this moves out from this area, you got a long, lengthy leg out, almost vertical movement, not this basing away crap right here, guys. You see this right here, how the market came down? I guarantee there's a base in here, but it's probably going to be on the left side. But this is not a good quality zone because the way that this thing based was literally just kind of like it just didn't have any strength in it. When institutions place $1 trillion or $2 trillion in this currency market, billions of dollars, that's going to be a strong movement going down. Okay. Let's see this. When the price of the market starts to, oh geez, I might just throw that one away. When the price of the market does this movement and it just slowly goes away, they didn't have a lot of strength of the orders in here. You're not going to get the full retracement. This is kind of like okay, but it's not the strongest score. Okay, it's more consolidation than anything. I want a strong move away. So when the price of the market gets back up here, you know that this thing will retrace about as far as how it came down, at least 3/4 of that. Okay, that means there's a lot of orders still left in here when it comes back up. We need the highest probability that this is going to work in our favor. So when I'm looking for a retracement means that how far did this market move before coming back? And so that's the retracement. Time at the level just simply states that when we're in this zone right here, this is often called a zone or retail area or institutional selling range because it's a range. When you hear demand zone and supply zone, typically that applies to futures and stock. It was actually created from futures. In Forex, it's actually not even demand zone or support and resistance. It's actually institutional selling range, okay? So when the price of the market comes to this area, the highest probability is when you have one basing candle, okay? One basing candle simply means, look, imagine you being in a ring with Mike Tyson. I hope no one's in a ring with Mike Tyson. The price of the market starts to come up, right? The price of the market is someone walking up to Mike Tyson. This is a bad idea, guys, by the way. So Mike Tyson, you said, hey, Mike Tyson, you speak very funny. I don't like your voice. And he got insulted. Guess what he's going to do? He's going to hit you really, really, really hard. And what this means is that impact from that first blow, it took no time at all. This is a bad example, guys, but just bear with me. I'm going somewhere with this. When the price of the market starts to rally up, who has the ability to stop all of that? Look at what's happening right now. I'm going to come back to this chart, Cat Yin. Look at what's happening right now in the commodity futures market for the S&P 500. Look at what's happening to the market. Who has the ability to stop all this? The bulls or the bears? The bears are saying we need to drive the market down. Which one, guys? The bulls or the bears? The bulls say we need to drive the market up. So when you imagine this, and this is how I teach people on when we start to learn in the beginning. Of course, the bullish market, you imagine how the bulls fight. They have horns and they will thorn you upward. And the bears, although they run on their legs, they will stop, stand up, and swat downward. So as these bears are coming down in the market, and it's pushing a huge amount here. This is literally 1,800 points or 13.5%. That is huge. The only person who can come in and stop it is the bulls. And quite often, the bears at some point may stop selling off. Okay, so they'll do like this J-hook formation, which is really the buy the covers coming in along with these slow selling pressure. They have the ability to drive the price of the market up. When they're driving this market up, that's a sign that they have the ability to stop it. But look what happened. The bears came back in and drove the price of the market down. Guess what they did right here with unfilled orders? They increased them. In order to stop this from going up, they had to add money to the market. They had to add more orders that are unfilled to sell. They're going to get some orders. They'll probably get about a quarter of whatever's here. So let's call this 800,000. The institutions can get about a quarter of that, but guess what they're going to leave right here? 600,000 sitting on the books, waiting to be filled. So it will be 600,000 unfilled orders sitting on the books and waiting for the price of the market to come back up to touch it. Okay. So when we're looking at this CAD yen and we're saying the time at the level on the 1 week, in order to stop this rally, they had to create selling pressure. Maybe it was $50 billion here to drive this down, to the initial drive of this market. Well, the next time they came to this market, guess what? They touched it right here. The price of the market came back to the selling pressure. And many people will look at this and say, hey, and look how that landed. You guys think that was an accident? Man, that thing was, can you guys see this right here? right? There's a lot of places that say, well, wait for it to get to this wick, wait for it to
Yep.
get to the body of the candle, but guess what? That's still a touch. You guys see that? This is still a touch. One thing is when you're trading with this website, this is TradingView, they go by what we call mid price. Okay. So we can't put this on the ask price, which is for the sellers. You guys remember that from last week? Ask is the sellers, bid is the buyers. So this price should shift up a little bit higher to where this is. The other thing is we always get out before the price of where the unfilled orders are, because institutions like to play with people and get a paycheck before this level. And then they got it again right here. Now, this is a random chart. I didn't go out and practice this chart before I came to you guys. This is something that one of the members had actually posted. But this is the second time they got this level. That means there's a lot of orders sitting in here. Let's call that again. Let's call it 5 billion. Unfilled orders. Some of them got filled, drove the price of the market down. When they came back to this level, maybe there's about half left. So they got about 2.5 billion left in there. So maybe they got 1 billion of this 2.5 billion. Okay. And so forth and so on. The first move, maybe they got about half of that filled, 2.5 of the 5 billion. So this is how the price of the market works. We're looking for the unfilled order of inventory. And that's why Professor says a range, because the institutions like to play in a range. If you would have been looking at the body or the wick of the candle, maybe you would have gotten filled. And guess what? You would have got one fill here and you missed out on a paycheck. We don't like to give up cash, because I'm going to ask you guys a question. And I want someone to answer this for me. If I gave you $100,000 on the table and I gave you $1,000 on the table and said no consequences, which one would you take? You can write that in the chat, or you can verbally mention it. Someone heard you.
Oh, yeah.
Oh, you heard my joke before, huh? And the reason why is you don't want to leave money on the table, right?
Nope.
Never leave money on the table. This happened in gold. See, it's not when you have an authentic level or when you have a high time frame pivot reversal pattern. At a high time frame weekly, at the end of a market, guess what that's giving you? That's giving you a reversal sign saying that that is a strong market. I caught the S&P last 2018. It was a 20% drop, and it was a reversal pattern in the bonds market, and it was inversely correlated to the S&P. These reversal patterns work on high time frames very, very, very well. Okay, just remember that, guys, when you're trading in the future. Reversal patterns, drop-based rallies, and rally-based drops work very well on a high time frame at a pivotal area, because that's where you're supposed to trade them, unless you have a wall making this authentic. Okay, right here, this is a wall, a nice rally. That means everything below this is going to be, inside of this is going to actually be authentic, which is why you have the median retest there. So any questions on this part where you guys are looking at the unfilled orders? The retracement, right? The retracement is how many orders sent this all the way down before it retraced back up. Sent it all the way back down again. The next one, fresh and authentic, we kind of covered a little bit of that. Simply just means when a market is fresh, it's just a clean level that doesn't have anything to the right of it. When it's authentic, and guess what? The fresh level was created by something. So the fresh level was right here. This right here was a fresh level at one point. Got tested several times in the market. This was a drop-based rally. You had the wall here, so this was fresh and authentic. I don't really like it because it was a reaction off of this. I would have preferred this to actually have a clean wall all the way down like this and not have this level here, because this is still fresh and not authentic. That's not a good, solid, clean wall. This is a rally-based rally and it retests off of this, but this is still a level, guys. This is still a level that was formed. So you got 1, 2, 3, 4 times into this level, 5 until it broke out and started to go down. So this level worked because they were going deeper and deeper before they can get all the orders out. This is a rally-based rally here. This is authentic. The authentic level will create fresh levels in the future. Look at this, drop-based rally, drop-based rally. So you always have to look at the big picture and step back to realize that, yeah, I found a level here, I should respect it, but it may be fresh and not authentic. Rally-based rallies will always be authentic, okay? A rally-based rally will always be on an authentic level. A drop-based drop will always be an authentic level. Reversal patterns, unless it's at the highest pivot, will be fresh, okay? Or either it's in supply or it's in demand. That's going to be fresh. Okay. All right. So here's a retracement. Came all the way down, came back up. There was a lot of strength in that, almost 900 pips. That's quite a bit. This one right here was about 2,600. That's a huge retracement from whatever it hit down here, right? So when you're trading these, you're going to make sure that you're looking for the highest quality. Now, the time, I would say 1 to 2. If you're trading a rally-based rally, one of those candles better be red if there's 2 candles in the base. If you're trading a drop-based drop, one of those candles, they better be green, okay, in a drop-based drop. If you have 2 or more, and I don't want to go, actually I would say 2 to 3. We never really go more than 2 to 3 candles in the base. And the reason why is because as the orders are going back and forth, they're eating up the orders inside of the war zone. This is the concept and the theory part that a lot of people don't understand. The size of the base. Let's go into it really quick. Let's find out what this is. Now, on TradingView, there's a tool that we like to use for short and for long. So if you look at this, and you guys, I want you to start using this tool. This is a pretty cool tool. It gives you an idea of your risk to reward. But I'm going to look at the entire amount of risk of where this actual institutional area is to sell. So what this is telling me is my risk to reward is 4.5 to 1, meaning it's 4 times the amount. This range of retracement, how far it moved away from this base, gave me an idea of how much follow through there was in this range. There was a lot of orders in here that sent it down. Okay. So when we look at this, we say, okay, well, 166 pips, the total amount, 751 as far as the retracement. That was a high probability that this trade was going to work in our favor. Okay. So that would be one basing candle. When you start to have multiple basing candles in a zone, they're not high probability. The highest probability for a trade working would be how it came up, would be one basing candle. So we have a drop-based drop here with one green basing candle. If there was another one, like these guys right here, this is a drop-based drop, immediate retest to the level, but guess what? You got blown through, and they went to a higher zone, which very close proximity, guys. They were still testing this level, went to the higher level. So people get blown out through their zones a lot because they'll say, oh, well, here's a drop-based drop. It just looks clean. It's higher on the curve. You know, they'll bring up the Fibonacci and they'll say, hey, look, this thing is higher on the curve from here to here. And they say, well, I should be shorting higher, right? But guess what? This is still where, guys?
Middle of the curve.
Middle of the curve. Stay out of that. You want to go where?
High on the curve.
High on the curve, 75% and higher. So that, even though it was a supply level, got an immediate retest, people will say, oh, well, this is a good level. I'm going to stay safe. I want you guys to stay safer. Sell high, buy low. Buy low, sell high. Stay out of the middle. This is a good example. Now, let's look for another one that actually has 2 basing candles. Oh, man, this thing is just so choppy. Look at all this. This is choppiness right here. So imagine that this market is trading right here. And you have a strong rally up, a strong base out, right? Nice rally. 2 basing candles here. But the problem with this is look how it started to already come back around. When the price of the market moved away, you got to look at it like, how much did this move? Remember, when we look for retracement, this is the wide range of that. That's just terrible. You don't want something that has a huge wide range. You want something that has a smaller range and a long follow through, a long arrival in and a long arrival out. The arrival of a base is so important. It's just as important as a leg out. And a lot of people don't realize that. It may just look a little bit clean, but we want to make sure we're looking at rally-based rallies where they have a long rally in. So looking for 1 basing candle would be the highest probability that that trade is going to work in your favor. 1 basing candle, okay? When it comes to levels, I'm going to kind of point out a couple level on levels because they don't have to be right after each other. A level on level could be, let's look at another pair, or you guys want to look at something else? You want to look at the dollar or gold or silver?
Dixie.
Okay, let's look at the Dixie. US dollar index. And one thing about the Dixie, what you guys need to understand is that it's the currency used most in international transactions, okay? So that's why it's weighted more so with other currencies, and it's not just the United States, okay? If you go to our library, you guys have access to the library, you can see where it's US dollar weighted, and you can see how much transacted back and forth, okay? Now, 80% of transactions are conducted through that dollar around the world. And one of the best things the United States did was bring our dollar to all 4 quarters of the world. Look at this right here, guys. What do we have? We have a drop, a base, and a drop. Not the best zone, right? Because we have more than one. Again, the highest probability is when you have 1 base within the arrival in and arrival out. Look at what happened when the price of the market got back to this level. They gave confirmation it was getting ready to come down, but guess what? It just went sideways for a while because they're eating up the orders. It's not the best price. It's not the best probability, and then eventually they broke out. Okay. So when you're trading zones, just make sure that you guys are looking for the highest probability because we're putting our hard-earned money on the line. You want to make sure you're looking at something that has 1 basing candle in it. So right here, I just identified what we have a level on level with an immediate retest. All right. Now, who can tell me what this level on level is? Is it supply or demand?
Man.
Exactly. Now, with this level being demand, we have this one here. And then you have this level right here that was created directly out of it. And you have this level that was created again. Now, I just want to kind of give you guys an idea of this. There's a couple rules. I don't know if this is ever explained to you. There's a couple rules with level on levels. When you're trading a level on level, the highest probability that any of these will work, okay, is when they're separated and not touching, but they're directly after each other. This one right here, you do have the price of the market came back down, tested this level right here, right? So when the price of the market got here, it ate a little bit of the orders. It tested it and shot out. There's an immediate retest. What we don't like about this is that the wick of the leg out exceeded the base, okay? When you're trading an indice, for example, can you guys see this? Me changing screens here?
Yeah.
When you're trading, okay, great. When you're trading an indice, these indices like the dollar, the Dow Jones, the Russell, the Nikkei, the VIX, right? Let's go to these currencies. All of these currencies, the way that futures work all these currencies are against the US dollar. Euro, these are the major currencies that trade all against the US dollar. So when we're trading this Dixie here, when you're looking at this, the price of the market dropped below here. That's bad. But when you're trading indices like the S&P and the Dow and stuff like that, or the bonds market, it's high probability that they will still come back and test this market. In Forex, we do not take wicks that have exceeded the base. Make sure you guys remember that. In Forex, we will never, I'm going to repeat it, we will never take the zone that has the wick that has exceeded the base. I would rather look for another trade. So for level on level, the highest probability of it working would be, let's find a demand zone on demand zone, or let's say a rally-based rally, where they're not touching. Okay. I don't think we've ever covered this with you guys. So when it comes to the second highest priority that this will actually work, the second probability is when you have a rally-based rally with another rally-based rally or immediate retest to the rally-based rally. That would be the second highest probability that it will work. Okay. So for this example, when the price of the market rallied up and created a base, even though it exceeded it, we're in a indice, they do hit a lot of times, more so than not. This one actually went into the price of the market right here and then shot out. And this one actually went into this one. Okay. So it still worked on its way up. But what I like to see is for this wick to not exceed or go into it and stop right here above the actual basing candle or above the wick of the zone. Does that make sense to you guys? You want me to further elaborate on that? You guys get that one?
So this was like an exception of what you're saying, right, Ramar? Is that what you're trying to say in this one?
Mm-hmm.
Because this one did exceed it and it still worked out.
That's correct. So remember, when you're on zone violations, works more so than not, regardless when there's only the wick exceeded into the base. I don't want the body of the candle exceeding that. And I'm going to go through a little bit more. I've never taught any of you guys this stuff or kind of gave it to you in the signals, or, you know, sometimes I'll write little notes, but when I'm posting signals, the body did not exceed. I want this staggered formation. So I'm going to zoom in here. I know this looks crazy, guys, but I'm going to zoom in here because there's a huge lesson in this. When you have a zone or you have a range where the leg out candle, most of the time you won't find them staggered like this. You know, Professor, for being the wick king and letting you guys know that if the price of the market, let's say that the wicks, they were exceeding. This isn't Forex. This is why Forex is a little bit different than indices. But you still have to look at the Dixie or the dollar index when you're trading. So if this never happened and the price of the market stopped right here, you have this uptrend wick formation. If the price of the market comes back down here, this is the highest probability they want to take the price of the market up. One thing that I've never taught anyone other than the trio is that when you have this body formation, that's higher than the base, staggered like that, that's the highest probability that this will work when the price of the market comes back to that level. Okay, that's the highest that is a very high probability that's going to work and come back to the level. I don't really cover this too much with too many people, and the reason why is when the price of the market starts to go up, it works mainly in the indices, not necessarily in the currencies. Okay, but you will once in a while find this formation, guys. Never forget that it's not just the wicks, right? But it's also when you're trading indices like gold or silver or oil or the Dixie, make sure you're paying attention to the wicks. Okay, that's high probability that that's going to work.
So you're saying that whenever that formation happens, they're going to come back and retest that area and shoot it up?
Yep. Look at this one here. Did the leg out exceed the body?
No.
Yeah, it did. It's
Oh,
staggered.
so you're counting the wick as well, not just the
not
just
the
the
wick,
body.
but I'm also counting the body.
Okay.
Many of you guys have been taught this right here. Okay, professor will do this sometimes, right? And when he's done his webinars online. But what I'm telling you guys is this: it's kind of in Forex, when he's doing Forex, he'll do this. But the body formation, when you have also a body formation like this that's staggered, that's high probability that when the price of market comes back down here, guess what's going to do? It's going to respect the level in reverse. That's right. So that's a new one for you guys. I've never really shared that. It's just my secret sauce, and I'm sharing that with you guys because I love you all.
Incredible. Thank you.
You know, so when you have the highest probability of a level on level, can't type today, guys. When you have a level on level, two levels, right? There are other rules as well where you'll say, okay, well, I'm going to go and divide them in half and take the lower half of it. But when I have a level on level, I'm going to wait for confirmation and possibly set like a buy stop order or a sell stop order. Okay. So what I want to share with you guys, let's see the wick formations. Let's move on to the next topic. Okay. We're going to go to support and resistance. I know a lot of people have a little trepidation about that, but we need to cover support and resistance because it applies to several different types of markets. So let's talk about support and resistance. Let's talk about support and resistance. On support and resistance, the highest probability that these will work is when you catch the first and the second move. What creates support and resistance are it could be a zone or the institutional selling range or the institutional buying range, okay? Meaning the rally-based rallies, the drop-based rallies, the rally-based drops, and the drop-based drops, okay? So the highest probability that it's going to work in your favor is when you get closer to the actual zone or the institutional unfilled orders themselves, that range. What happens is you can find support and resistance more so than not in a ranging market. It's always in a range bound market. And the range bound can be channeling uptrend. It could be channeling downtrend. Okay. We're going to go find some. I know this is outside the box for you guys, but what we're really talking about is when it's in the uptrend, you're looking for higher highs and higher lows, downtrend, lower lows, lower highs, right? Sideways market, relative equal. But this applies very heavily when you're looking at patterns like range bound patterns, like triangle patterns, stuff like that. So let's go back to our dollar index. I want you guys to see something really quick. Let's go and let's delete some of this crap that I got on here. Let's go to here, blah, blah, blah. All right, let's go up to a 4-week. Okay. And in a channel, it doesn't necessarily have to be this zone right here. You have this rally-based rally formation. But in a channel, you would use the highest pivots to identify the range. Sometimes the support on this can actually change. With this pattern particularly, what we actually have is a descending triangle, okay? You have a descending triangle here. But the part that you guys need to understand is the support. We will find support on the pivotal areas, okay? We will find support on the pivotal areas. So in order to identify support, there's what they call a gentleman's rule, right? You're looking for 1, 2, 3 touches to go long. It's confirmation. But more so than not, after it's been touching so often, it will break out. They call it sometimes on the futures commodity exchange a 3-touch breakout. They'll sometimes call it a two-touch breakout, because after the two touches, it'll break out the next time it hits it. But it's more so the gentleman's rule, 3 touches and then the breakout. So we have to let you guys understand that when it's channeling or going up, you would use the higher lows to underline the pivots. Okay, so you have a low, you have a high, you have a higher low, you have a higher high. So as these start to go up, it's making higher highs and higher lows. The trend can always change like this. And the price of the market, very often, if it has a trend change, will come back and test the original range as it's going back up. You guys have probably seen that before. So where you'll have several ranges that break out and then they continue in the upside. It's like, I thought it was going to break out. Now, let's look at a sideways ranging market. Let's go down to a 1 week, probably a 1 day. You'll see a lot of this on a smaller time frame. So let's look at this. Let's look at this resistance really quick. You would typically want to use the high part. Okay, you want to use the high part of the pivots. Although this is part of the resistance as well, it does count, but you would want to use the highest part of it to identify resistance. Okay, and what this market is actually doing, if you look at the trend line from here, this has been going up, okay, into a, what we call a, this is more of a ascending triangle as it's going up, because we're expecting it to break the top side. So we have several things here that we need to look at. This is the support. You would identify it by the pivot lows, or what we call these in the up market, higher highs, higher lows. You identify it by the higher low pivots on the lowest part. Okay, so we're not going to use this. We're going to look at the lowest pivots. Okay. So this is 1, 2, 3, and then the gentleman's rule, it broke out. You guys see that?
Sure do.
Yep.
All right. So now we're identifying what we call point of control. We'll get into that as we go more into trading and investing. But here's resistance. Here's support in an uptrend. We'll look at the highest pivots. We'll look at the lowest pivots for support. So let's put this in our notes here. For support, you're going to use the lowest pivots. Okay, and conversely for resistance, you're going to use the highest pivots. So even if it's relatively equal high, relatively equal low, you're going to use the ones that are on the outermost part of this range bound market and the lowermost pivot on this uptrend market here. Does that make sense, guys?
Yes.
Yes.
Now, what I was referring to when it came to support, where the market could be trending below, is this right here. The price of the market could be respecting something else. You see that, guys? So you have to always, we don't trade support and resistance because it's retail information, but it's also good to know it, because here's the reason why you want to know this stuff. If the price of the market was range bound for a long time, and Forex does range bound for a long time, the dollar does range bound for a long time, or channel for a long time in a direction. If the market is going in a direction for a very long time, it's letting you know if you're higher or lower on the channel, you should be expecting to buy low and sell high. Okay, but we don't trade the channel itself. We trade the range bound unfilled orders or demand or supply. Okay. And one thing I want to share with you guys about the range bound markets, when a market is range bound, 20 to about 30% of the time, it's in a trending direction, meaning either uptrend or downtrend. If the price of the market is on a high time frame, it looks like this. And people say, well, wait a minute, this doesn't make sense to me. Zone share. Let's do this. This doesn't make sense to me. When you look at something like the S&P 500, the S&P 500 on a, let's look at this on a 4-week. Would you guys not argue that this is not an uptrend? I mean, guys, come on now. Let's look at this. This is really uptrend, right?
Oh, it's an uptrend.
Yeah, that's a huge uptrend. Anybody disagree with that?
Nope.
Okay, that's an uptrend market. But when you break this down to a lower time frame or intermediate time frame, like a weekly, guess what? This market is not doing anything but going sideways. So that's going to be 70 to 80% of the time the markets go sideways. So let's go 70 to 80% of the time the market is sideways. It's range bound. Hence why we say supply and demand. Hence why we say support and resistance. Does that make sense now, guys? So I'm going to go through this really quick just for time's sake, and I'm just going to identify some relative equal highs, relative equal lows for this range bound market, okay? There's a lot of channeling here too, and that counts as well. You can probably see this more so on a... So when we're looking at this, the majority of the time the market is sideways, okay? That's 70% of the time the market is sideways. It broke out, created another higher range. This actually continued all the way over here. This market is sideways. You guys get what I'm saying here?
Yeah. It's interesting.
So on a intermediate lower time frame, the market is typically sideways. On a higher time frame, I would say 4 week and above, the market typically trends in a certain direction. Okay, and that's where we come up with supply and demand, support and resistance, is because of that range bound. And range bound markets can break out. A zone is a zone until it's not anymore. A range is a range until it's not anymore, guys. I mean, that's just how it works. So, but when you break it down to a daily, this stuff really is range bound. It looks crazy range bound. You can see it better here. You guys see all these ranges? Now, what creates, and I want to draw you guys into this, what creates support and resistance? These lines here, these trend lines.
Institutional zones.
Institutional supply. Yeah, you're absolutely right. Very good. So you have this drop-based drop here that created supply. They'll come in here and test it. Here's one immediate retest of the level. And then you have this resistance. You'll have a drop-based rally right here. And what happens is the institutional traders or the retail traders will come in and try to get 1, 2, 3, 4, and they'll say, hey, we have support here. So the next time it comes back down here, we're going to trade it. And guess what happened? It broke through it. That's why you got to be careful with support and resistance. If you don't catch it closer to the range, I mean, to the actual unfilled orders, it may not work out in your favor. Gentleman's rule, 1, 2, 3, and look what happened. So Professor and I, the trio, we never trade support and resistance. We know it's there. It's after the fact. And what we're really looking for is the unfilled orders of supply and demand, because that's the highest probability where the market will get its retracement and its retest. Does that make sense to you guys?
Hey, Lamar, how come you're not counting every single touch there as a 1, 2, 3? Like that looks like 1, 2, almost a third, 3, 4.
Because when you use support and resistance, remember, you want to go to the lowest. So technically, it would be here, actually. 1, 2. You see that?
Yeah.
Is this also a touch to the zone? Absolutely, but that's not support.
So that's just an immediate retest.
That is correct. To this zone right here before it shot out. Support is identified by using the lowest part. You'll hear Professor say that. You hear me say it. You'll probably hear Cynthia say it. It's identified by using the lowest pivots of the actual zone. You see that?
Yeah.
Right? I wouldn't count the red one. I would just count this one right here. So, because that didn't touch it. So you have 1, 2, 3, gentleman's rule right here, and then you have the breakout. I'm going to zoom in so you guys can see that a little bit closer.
So you're really getting really specific on those touches. Really tight on that.
Yeah.
Yeah. Okay. Okay.
And the only reason I would consider this a touch is because it's so close to it, but these are not. These are level touches into the zone, but it's not support. The gentleman's rule for support is 1, 2, 3 touches. And I'm pretty sure if this chart was on the bid, remember the buyers, when we get ready to sell, those are the buyers. I'm pretty sure this line will go up just about a hair. So those are the gentleman rules, 1, 2, 3, and then the breakout. But we do not trade this. We look for, we're in, and we get our paychecks 1, 2, 3 before everybody else, guys. And as a matter of fact, the price of the market, I'm just going to make this guy right here. You have to actually use the lowest part of this wick, but I'm just going to use this one. I'm not going to go to the leg out, the leg in. This is the entire range bound of where the institutional orders are. The price of the market came down 1, 2, 3 into this area. I mean, they've really exhausted this level. They've exhausted this level all the way down into here, whatever was left in there. So the price of market, they got 1, 2, 3, and this was an immediate retest to this. But the gentleman's rule of thumb, 1, 2. Okay, we kind of beat support and resistance to a dead, kind of beat a dead horse. But does that make sense to you guys? We want to use the ones that's lowest to the actual pivots. We don't want to use the ones that's high and staggered. Now, if I was looking at just a simple range-bound market, is this sideways? Absolutely, because now you have relative equal lows, relative equal highs. Absolutely. But when I'm looking and measuring what I call resistance, I need to look at the ones that make the most sense here, here, and here. Okay? So we need to look at the ones that are at the outermost, or the ones that are on the resistance side for the outermost. That's how we identify support and resistance. But we always want to go for the range bound, because support and resistance is for retail trading. Okay? You guys okay with that?
Yep.
Never ever learn support and resistance. You just got a crash course in support and resistance. Okay? Now, Professor had a few things that he wanted us to cover, but before we get into it, I want to we just covered lesson 5, which is supply and demand. Lesson 6, support and resistance. I need to get into position sizing. You guys realize that the market is closed. I can't jump in here and just put in an order, but what I can do is I can bring up, well, I'm gonna have to log into my demo account in order to bring it up, and that's no problem, so we can see order size. But I just want to take a blank area, and I want to cover a few things with you guys on how to calculate your position size. In the library, we have a rule of thumb. Whatever your NAV is when your account size, let's call it 5 grand, because you guys are balling out of control now, all right? With the NAV in place, the rule of thumb that the professor, I don't know if any of you guys have seen this yet. Benji, have you seen this?
I have.
Yeah.
Okay. So the rule of thumb is when you're measuring your account value, you want to be less risky as possible. And I think the way Professor has this mapped out, he's using way less than 1%. Even though it says 2%, I'm talking 1% of your entire account balance. So the way he measures it is he says, okay, let's take 5,000 and multiply by 16 and then divide by 10. Okay. I have another formula I'm going to share with you guys. Okay. And we'll get to that, because it's so important that you guys understand your position size. You don't want to risk too much of your account. So if I had a $5,000 trade, someone do the math for me on that one. How much would I be utilizing per units?
500.
Okay, so 500. So every position, and Professor would say, I want you guys to use 2% rule from wherever you enter into this trade. Okay, so how much ever you can get on that risk. I have another one, and I use this one that Professor he puts out. I have another one. I'm going to take my account size, which can be $5,000. Right? Let's add a lot more zeros though. $5,000, And what I want to do is I want to measure out what my risk is on a trade. So let's call that risk, oh, let's call it 2%. Okay. What's 2% of $5,000, guys?
100.
$100, right? So that's going to be $100. I would then multiply this $100 by my actual pip risk. So if I came here and I said, okay, let's measure out a very tiny zone. We had the CAD yen a little bit earlier. Let's find us a very, 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 very tiny zone on the, let's go with a 30-minute, okay? So for the 30-minute, let's say that we have this zone right here. We have a rally-based rally, level on level, right, guys? Level on level.
Right.
Let's see what the pip risk is on this. I'm going to do magnet mode, snap it to here, to here. We got 10 pips of risk. What about this one? Let's see what this one's going to be. This one from wick to wick, 17 pips. Let's just round it off to 20 for numbers sake, okay? And since we get in early, we should probably use 25 because we always get in earlier than expected.
I'm sorry, Lamar. This is Professor.
Hey, man, what's going on, brother?
I'm good. How you guys doing?
Great.
Good.
All right.
Just jumped on real quick. When you do the math on the 5,000, so 5,000 times 16 divided by 10 is actually 8,000.
Actually, 8,000, right?
Yeah. So the number of units should be 8,000 units.
Ah, okay.
So
Who
that's
gave
how
me that?
many units. I don't know. Because when somebody said 500, I'm thinking you can't have a lesser number when you're multiplying. You can't have a lesser number than what you started with. It's got to be greater. So we started with 5,000. So you multiply that times 16, then you divide that by 10. That gives you 8,000. So based on that, you should not be trading more than 8,000 units on a $5,000 account. And then to be even more conservative, I also have the calculation of whatever your NAV is, you can use that same size of units, so 5,000 units. So you guys would choose which one you want to do. If you multiply by 16 and divide by 10, you can use 8,000 units. If you want to be even more safe, then just use the same unit size equal to your balance, which would mean 5,000 units. So those are the two calculations there.
Perfect.
Yeah. Of course, with the 2% stop loss. And if you guys are
Always.
counter trend trading, I lower the stop loss to 1% in case the counter trend goes against you.
But when you guys are doing this, you're not considering when we start doing pullbacks and add-ons, right? So your unit sizes can continue on that trade.
Even if it's a pullback, you do the same calculation here.
No. But I'm saying overall, I mean, you guys keep adding on, obviously. So you just don't do one trade and stick to that one unit size. If you do an add-on, all of a sudden it can get to 16, and then.
Well, remember, you're using margins. So when you start to look at what your available NAV, it's going to be a lower number when you multiply by 16 and divide by 10, right?
Oh, I see what you mean. Okay.
Right. So even if you are counter trend trading using 1% rule, your NAV at this point, I mean, it's going to be smaller. So when you multiply your account balance by 16 divided by 10 is going to be a lot smaller unit size that you're using if you're sticking to your rules. You should be sticking to your rules. So conservative using 1%, that's 1% of whatever you place your unit. Professor, what I've done is the calculation, and I realized that it's not even 1% of your entire account. He doesn't risk that much. That's why he's able to ride the wave. He's risking 1% of wherever his entry is to his stop loss, but his unit size is so small. I had to tell him, hey, man, you're actually under 2% of your overall account on every single trade, man. He's staying very, very conservative. So let me give you an example of what that is. If we had a pip risk of literally 25. Okay, I'm going to bring up my calculator here on the side. And we had $100, and we multiplied that 0.0025. I'm sorry, I think I'm supposed to divide that. Let's see here. Stand by, guys. $100 and divide that by 0.0025. I'm using now 40,000 units, which is what I started with, which is 2% of my account. And when I started blowing up trades here and there and being more risky, it wasn't blowing up trades. It was just that when the trade didn't work out in my favor, my risk was very high. So which one would you guys like to be, conservative or very risky? 2% of your entire account, or your position size where you're going to actually keep your account safe and still ride the wave, still be able to, because here's the thing, if you're moving a couple pips on this versus 2% of your entire account, riding the wave with 40,000 units versus 8,000 units is going to create a lot of negative emotion, especially if you have to ride the wave on like a pound Kiwi that's 50 pips. Does this make sense to you guys?
Yes.
Yep.
So when I was doing this, professor was saying, hey man, you're not being conservative enough. You need to use a position size that's going to be a lot smaller. So it's not 2% of your entire account. He's risking, when I did the math, and I think he was risking, well, let's see this. What's 40 divided by 8,000? We're using the same number, 5,000, right? 40,000 units divided by 8,000 units.
5.
I mean, yeah, it's 5, right? So he's using literally a fifth. He's using literally 20% of what I'm using. He is literally keeping his account safe. So you got to stay safe when it comes to position size. When you do position sizing and your trade management, you shouldn't be risking all of your units because you need to have available units for pullbacks. And that's where it comes into having paychecks. If you were to take the next trade and your available NAV, let's say you had about, I don't know, 4,000 left. Let's do the math on this one. 4,000 units, Juan, with 2% rule, okay? So we're going to be conservative. We're going to multiply this by 16. Somebody divided by 10. What's the numbers, guys?
6,400.
6,400 units. Okay. So, and we're still going to use, if we're conservative counter trend trading or buying on pullbacks, we're going to use a 1%. Okay. So not only are you being conservative using less units available, you're being conservative with a tighter stop, because pullbacks are meant, you don't want it to pull way back against you. If it goes against you, it's small, but you don't want to be risking a lot of capital with a huge amount of risk with your actual percentage when you're using a 1 or 2% rule. Okay. Any questions on this, guys? That makes sense?
Yep.
I want to add a comment.
Yes, sir.
On there. So nobody asked this question, but I just want to throw it out there. The reason why you use 2% stop loss for the first trade is because the first trade should be at the pivot high or at the pivot low. And when you're at the pivots, remember, we're getting in early and they could go all the way to the pivot. If we're getting in early, we're not at the actual pivot. So you want to give yourself room for that thing to possibly go all the way down to the actual pivot. And when you use 2%, 2% stop loss is generally below the pivot. So we're getting in above the pivot and the markets could go to the pivot, and we want our stop loss to be below the pivot. When we're doing a pullback, we don't want to have that much room, like Lamar is saying. We just want to be able to catch the pullback. And if we can't catch it within the 1% stop loss, then we'll just give it up. And we'll maybe place a buy stop or a sell stop and wait for it to come back around to us and then ride it the rest of the way. But you want to have the biggest stop loss at the pivots. Everything in between those pivots, which are just the pullbacks, or well, I'm not going to say or retracement, but basically just the pullbacks. You don't want to have a huge stop loss for those pullbacks. You just want to catch it and keep moving. So that's the reason why the stop losses are different. And then if you use the times 16 method, you are conservative. If you use the same amount of units as your NAV, you are being super conservative because you're using even less. So using the 5,000 example, then you want to be conservative, you're using 8,000 units. But if you want to be super conservative, use 5,000 units, which is equal to your NAV. So you guys be the judge how you want to do it. But either way, when you use those, you're going to be safe. You have lots of room to ride the wave until it moves into your favor. Keep in mind, just because it hit our, supply or demand, it could range to the side before taking off. And I'm sure you guys have seen that. That's why I don't move my stop loss even to a positive stop loss. If I'm at the pivot, I don't even move my stop loss to a positive stop loss until it gets out of that area of the pivot and actually creates another zone. Because if it doesn't create another supply or demand zone above the pivotal area that we just left, it's going to come all the way back to you, like you guys have seen a million times. It could go up and out of the zone and come right back into the same supply or demand, go up and come back, and it could just bounce back and forth 2 or 3 times before it takes off and leaves it. So you got to give yourself time and understanding that it's not just going to hit your entry and then move in your favor. It could go back to your entry 2 or 3 times. So just because you get out there, 20 pips, even though we say, put a positive stop loss after 20 pips, if it goes out 20, 30, 40 pips, but there's no zone in between where you started and the 20 to 40 pips, then don't put a positive stop loss, because most likely it's just going to come right back to where you are, stop you out, and then you got to get back in. It's better to just leave your 2% stop loss and just keep riding until it creates something or shows you that it's not coming back.
That's been happening to me so much this week.
Yeah.
Really?
Yeah, the key is just leave your 2% stop loss until it really gets away and creates a quality zone that indicates to you it's not coming back. So let's say you find demand and you get in just above demand and you're at the pivotal area, your 2% stop loss should be below the actual pivot. But when it leaves demand, if it leaves strong and out of demand, it did not create any more demand. So that means when it gets ready to pull back, it's going to pull back to the original demand area that you started at. So you want to see it leave demand, range a little bit to the side, create more demand just above you, and then take off. Because now you know it's not going to hit your demand that you entered at. It's going to hit the demand above you and then keep going if it pulls back.
Oh, that's great. Thank you for that.
That's when you want to change your 2% into a positive stop loss at that point, when you have additional proof that they truly are moving up. Because until they create more demand, and watch this, I'm going to have you guys think outside the box. Until they create a new, if we're talking about demand, until they create a new higher low, you are not safe yet. Because the new higher low is the new demand that they're going to bounce off of to continue the uptrend.
Man, Professor, that was an aha moment right now.
Can you show that on the chart, Lamar?
So, Professor, what if it has like, from our entry, what if it has like a very big move out, like right there where Lamar is showing right now,
Or this one.
yeah, that one.
Okay.
When will we kind of like secure profit, or think that it's not gonna come back?
You're exactly what I said. It's unfortunate when you look at something like this, but where Lamar is, let's say you got in right there, and then the market goes up, and then the market pulls back. You can see, go back to Lamar, that first wick over wick pointing down, the bottom of that wick over wick pointing down, that is the new higher low. If we go on a smaller time frame, that's a higher low. The bottom of that wick. Yep. You guys see that?
Yes.
Yes.
Yep.
I agree with you, Jennifer. That was an aha moment.
So once that, yes, once that first pullback happens and then they take off again, that pullback created a new higher low. That's when you can move your stop loss because they're not coming back to your original entry. If you move your positive stop loss any earlier, there's a chance that it could come right back to you. Because Lamar just showed you guys earlier, it ranges to the side before it takes off up or down. That range to the side, it just keeps hitting the same area 2 and 3 times. That's what the gentleman's rule is. The 2 or 3 touches, whether it's support or resistance, those 2 or 3 touches is simply it going back to the original zone over and over again. And you guys have to get used to that. It's not going to always hit your zone and take off, hit your zone and take off. Sometimes it'll hit your zone or hit your entry, go up, come back. Hit your entry, go up, come. It'll keep coming back to your entry 2 or 3 times before it actually takes off.
So almost like waiting for another pivot to form that's above.
Correct.
Okay.
That's exactly what you're waiting for.
In a smaller time frame, that's what it's doing, right? Ranging.
Correct. It's going to range until it creates, it's going to range until it takes off. And if we're talking about demand, it's going to range until it takes off and goes up. Once it goes up, you're still not safe until it pulls back and then goes up again. That pullback created a new higher low, and most likely there's some demand in there. And that's what keeps you knowing it's going to continue the uptrend and you're okay to move your stop loss. And you can do that on a small time frame. You can do that on a 15-minute chart. You don't have to. What we're looking at here is too big. This is a 8-week, 2-week, whatever this is. So I'm not saying use these type of charts, but I typically use a 15-minute chart and I wait for a pullback on the 15-minute chart. And when I see a pullback and then it takes off again, I look at that pullback and I go, oh, that's a good pullback. I see demand on that pullback. So now I can move my stop loss to positive.
Beautiful.
So
Thank you for sharing that.
You're welcome. Let's imagine that the bottom of the market there where the red candle is where you entered. Right below Lamar's first, where he's first tagging or whatever. No, the very bottom, Lamar. Yeah, let's just say you entered where the red candles are, right there. Yep. Let's say you entered right there. That was your original entry. You found that and you said, I'm going to enter the market right there to go long. You are to keep your stop loss at 2% below that entry until, as it's rising up, it pulls back like it did above and then takes off again. Once you get that first pullback, now you can change your 2% stop loss, which is a negative stop loss, to a positive stop loss, which simply means you're moving your stop loss from below your entry to above your entry. And you only want to move it above your entry equal to the number of spread. So if spread is 3 pips or 5 pips, then you would put your positive stop loss 3 to 5 pips above your original entry. And you're going to stay there until this thing takes off again. And if you see the second one where he puts the word add, that second one, when it pulls back the second time, now you're going to move your stop loss below the first pullback. And that's when you're going to start capturing your profits. So when you get to the second pullback, now you can move your positive stop loss to the first pullback. Move your stop loss up. Because most people, what they do is they would keep putting their stop loss directly under each pullback. But the problem is each pullback may not be quality. Now let me say this as well. If your interest is to scalp or day trade, you want to put your positive stop loss under each pullback after they're created. Immediately after they're created, you put it right under the very first, let's say the very first pullback. If your interest is to wealth trade and go for the long money, don't move it that fast because it could hit it and now you're out of the trade and you got to start all over. You just ruined your wealth opportunity. So you don't want to start moving your positive stop loss until it creates the second pullback. You want to be double safe on a wealth trade, and you want to be single safe on a scalp or a day trade. So swing in wealth, you want to wait for 2 pullbacks before you move your positive stop loss. And then on scalping and day trading, you can move it immediately after the very first pullback. Because if it comes back and hits you, well, you're trying to make money right now anyway. So if it does go below that pullback, then you'll get paid right away. So it just depends. But then you got to go back in again, rechart, try to figure out where to get in, and all of that stuff. So I hope that helped. And you know, when we're teaching you guys all of this stuff, another thing I want to add is everything Lamar said and everything I'm teaching you guys, we're teaching you the exact same thing from a different perspective. It's like looking all around the house. You see the house from the front, then you see it from the side, you see it from the back, then you go in the house, you see it from the angle of different rooms. And if I first walk into a house and I see it from the front door, it looks different than if I'm looking at the house from the kitchen area. It always looks different depending on where you're standing. So when we're teaching you guys about support and resistance versus supply and demand, we're teaching you about the same thing. So supply may be at the price of $1. All resistance is 3 points that touched the same $1 price. So you have supply, and then it came down, went back up, touched supply 1 time, came down, went up, touched supply twice, came down, went up, touched supply 3 times. All that is supply, and those 3 touches are resistance, but they're all the exact same price. So we're not teaching you anything different. We're just teaching you how to see the same thing different ways. And once the 3 touches, which happens to be resistance, have exhausted all of those orders in supply, most likely it's going to go higher. It's going to have the breakout to the upside. And the reverse is the same. So if you find demand, that's the authentic level. And then support can come down and touch that demand once, twice, 3 times, that's support. And then most likely it's going to break through that support to the downside. So you're just looking at the exact same thing from a different perspective.
Thank you.
You are welcome. You're welcome.
I'll send this screenshot, guys, and I'll put it in the group so that way you have it. I'll actually put it in my notes. So I'm going to share all the notes with you guys so that way you can look at it as reference material. But I second that. We've always been taught after the impulse move your stop up so that way you lock in profits. No one wants to have a negative trade that went up and then it gave all the profits back. At least you were protected, so it's at a no-cost risk. And just to recap, when we were looking at the multiple targets, I want to make sure that you understand that you want to lock in some of that profit. The proper way to use multiple targets is not to just put on 1, 2, 3, 4, 5, 6 and it hit it, but to make sure that when you put this multiple target on, you're locking in profits. Wall Street, the way that professional traders use it is we will take 50% of our profits, so we locked in lunch. And then let the other 50% run to the next target and lock in another 25% and let the last one run. That's how you're supposed to properly manage a trade as it goes up or down in a trending market.